Have you ever wondered what bonds and treasury bills are? Well, you're not alone. These financial instruments might seem complex, but they hold a fascinating world within them. In this video, we're going to take a deep dive into understanding bonds and treasury bills, how they work, and why they are such an integral part of the financial world. So, whether you're a seasoned investor or just curious about the world of finance, this video is for you. Stay tuned as we unravel the world of bonds and treasury bills. Scene script. First off, let's answer the question, what are bonds? Imagine you're lending money to a friend. You give them a certain amount, they promise to pay you back in a specific time frame, and to sweeten the deal, they agree to give you a little extra for your trouble. That's the basic idea behind bonds. In the world of finance, bonds are like IOUs issued by entities such as corporations or governments. When you buy a bond, you're essentially giving a loan to the entity. In return, they promise to pay you back the full amount, known as the principal, at a specific date in the future. This date is known as the maturity date. But that's not all. While you wait for the bond to mature, the entity will pay you interest. This interest, or coupon, is usually a fixed percentage of the principal and is paid periodically until the bond matures. The interest rate and the frequency of payments are set at the time the bond is issued and remain constant for its entire life. Now, bonds come in different flavors. There are government bonds, also known as treasury bonds, issued by national governments. Then, there are municipal bonds issued by states, cities, or other local entities. On the corporate side, you have corporate bonds issued by companies. Each type of bond carries a different level of risk and reward. Government bonds are generally considered the safest since they are backed by the full faith and credit of a nation. Municipal bonds carry a bit more risk, but still less than corporate bonds, which are riskier but offer higher interest rates to compensate for the added risk. It's also worth noting that bonds are tradable. After a bond is issued, the bondholder can sell it to another investor before it matures. The price at which a bond is bought or sold in the market can be more or less than its face value, depending on various factors like changes in interest rates, the creditworthiness of the issuer, and the time remaining until maturity. So, you see, when you buy a bond, you're essentially lending money with the promise of getting it back with interest. Now that we understand bonds, let's move on to treasury bills. Treasury bills, or T-bills as they're commonly referred to, are short-term government securities. They are essentially a promise by the government to pay the holder a specified amount on a future date. These T-bills are issued with maturities of a few days to a maximum of 52 weeks, making them an ideal choice for investors looking for short-term investment options. Now, you may wonder, how do you make money from T-bills? Well, these bills are sold at a discount to their face value. This means you might buy a T-bill for, say, $90, but when it matures, the government will pay you $100, the face value of the bill. The difference between the purchase price and the face value is your profit or interest. One of the most attractive features of T-bills is their risk-free nature. Since they are backed by the full faith and credit of the government, the risk of default is virtually zero. You can rest assured that you will get your investment back along with the promised return. From the government's perspective, T-bills serve a crucial role in managing its short-term liquidity. Governments issue these bills when they need to raise funds quickly, often to meet short-term financing needs. When you buy a T-bill, you are essentially lending money to the government. But what happens when the government has surplus funds? Interestingly, it can also buy back T-bills before their maturity date. This is one way the government can manage the amount of money in circulation and thus influence interest rates. Investors, both individual and institutional, find T-bills a safe haven, especially during times of economic uncertainty. They offer a reliable return with minimal risk, making them an attractive investment option. However, it's important to note that while T-bills are considered safe, they may not offer the highest returns compared to other investment options. But for those seeking an investment that provides stability and certainty, T-bills fit the bill perfectly. To sum it up, buying a Treasury bill means lending money to the government for a short period with the guarantee of getting it back. You might be wondering, how do these bonds and Treasury bills work? Well, let's delve into the mechanics of these fascinating financial instruments. When you purchase a bond, you're essentially lending money to the issuer, which could be a government or a corporation. The issuer then promises to pay you a fixed interest rate at regular intervals and return the principal amount when the bond reaches its maturity date. This is why bonds are often referred to as fixed income securities. Now, let's talk about Treasury bills. These are short-term debt instruments issued by the government with a maturity period of less than 1 year. Unlike bonds, Treasury bills are sold at a discount and don't pay interest before maturity. Instead, the return on investment is the difference between the purchase price and the face value, which is paid at maturity. The buying and selling of bonds and Treasury bills happen in the bond market, which is a bit like a supermarket for debt securities. You can buy bonds directly from the issuer during the initial offering or from other investors in the secondary market. Now, onto a key concept: yield. The yield of a bond is the return you get on your investment. It's calculated based on the bond's purchase price, its stated interest rate, and the amount of time until it matures. Here's an interesting thing about bonds. Their prices and yields move in opposite directions. When bond prices go up, yields go down, and vice versa. This inverse relationship is a fundamental principle of the bond market. Why does this happen? Well, imagine you bought a bond with a fixed interest rate. If market interest rates fall, your bond becomes more attractive to investors because it offers a higher return. This increased demand drives up the price of your bond. Conversely, if market interest rates rise, your bond becomes less attractive and its price drops. As for Treasury bills, the yield is simply the difference between the purchase price and the face value, expressed as a percentage of the face value. Since they are sold at a discount, the yield is always positive. As we can see, the workings of bonds and Treasury bills are quite straightforward once you understand the basics. But why are these bonds and Treasury bills important, you may ask? Well, let's dive into that. Bonds and Treasury bills are integral to both government finance and personal investment strategies. They serve as a reliable source of funds for governments, allowing them to finance public projects and manage national debt. Governments issue these securities to raise money, promising to pay back the initial amount, known as the principal, along with a predetermined interest over a specific period of time. This helps stabilize the economy by ensuring the government has the funds necessary to function effectively. For instance, the Japanese Ministry of Finance, as we mentioned earlier, is looking to curb the issuance of Treasury bills, but continue with 40-year super long bonds. This shows the importance of bonds in stabilizing the government bond market. On the flip side, investors, both individual and institutional, find bonds and Treasury bills an attractive addition to their portfolios. They are considered safe havens, especially in times of economic uncertainty, due to their low-risk nature and guaranteed returns. Remember, the US Treasury Department, which kept its auction sizes steady despite uncertain borrowing needs due to the pandemic. That's because investors continue to trust these securities. They provide a steady stream of income, often used to balance out riskier investments. Moreover, the interest earned on treasuries is exempt from state and local taxes, adding another layer of appeal for income-seeking investors. They can be a great tool for diversification, helping to spread risk and potentially enhance returns. But it's not just about the individual investor or the government. The health of the bond and Treasury bill market can often serve as a barometer for the overall economy. A strong demand for these securities indicates investor confidence in the government's fiscal health and economic stability. On the other hand, a decrease in demand could signal concerns about economic health. It's a delicate balance, and bonds and treasury bills are right there, playing a pivotal role. So whether you're a government needing to finance a new infrastructure project, an investor looking for a safe, reliable return, or an economist gauging the health of the economy, bonds and treasury bills are key players in these scenarios. Clearly, bonds and treasury bills play a crucial role not only in the financial world, but also in the overall economy. So, what have we learned about bonds and treasury bills? We've embarked on an insightful journey, haven't we? Let's take a moment to reflect on the key points. Bonds, as we've seen, are debt securities issued by corporations and governments to raise funds. When you purchase a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal at maturity. Treasury bills, on the other hand, are short-term debt instruments issued by the government. They're sold at a discount to their face value, and upon maturity, you receive the full face value. The difference between the purchase price and the face value is your interest or return on investment. We've also delved into how these financial instruments work. Remember, bonds pay interest periodically, often semi-annually, and return the principal at maturity. Treasury bills don't pay interest up front. Instead, the return is the difference between the discounted price you pay and the face value you receive at maturity. The importance of bonds and treasury bills in an investment portfolio can't be overstated. Bonds provide a steady stream of income and preserve capital, making them a great choice for conservative investors. Treasury bills, backed by the government, are considered to be one of the safest investments out there, offering a nearly risk-free return. In recent news, we've seen how the dynamics in the issuance of bonds and treasury bills are influenced by factors such as market stability and government borrowing needs. For instance, Japan's Ministry of Finance plans to reduce treasury bills to stabilize the government bond market, while the US Treasury Department maintains its coupon issuance to cater to uncertain borrowing needs. Remember, understanding bonds and treasury bills is essential for making informed financial decisions. So keep learning and stay financially savvy.